Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It's Friday, February 27, 2026. The market tried to celebrate so-called good news, then traded like it suddenly remembered what it's really afraid of: sticky inflation and an AI shakeout that's picking winners and losers in real time. The vibe was risk-off. Mega-cap tech and the big financials took the hits, while investors hid in defensives and leaned into energy. Take a look at the S&P 500 Heatmap. This was one of those sessions where the board lies, just a little. There was plenty of green sprinkled around, especially in defensives, but the tape felt heavy because the biggest, most crowded rectangles were bleeding at the same time. Mega-cap tech was bright red, and financials were a nasty pocket of red too. When the generals fall together, the day feels worse than the index looks. So where did the money go? It hid. Consumer staples and healthcare were the shelters. Energy stayed bid too, with oil moving higher on renewed US-Iran tension in the day's news flow. On the other side of that trade, information technology and financials were the pressure points, and small caps, they got hit the hardest in this kind of de-risking move, exactly what you'd expect when the market starts pulling back from beta. Here's the core tension that drove the whole session. A hotter wholesale inflation print, PPI, pushed back on the idea of quick Fed relief. When that happens, markets reprice duration and high multiple growth feels it first. Then the second shoe dropped. AI leadership stopped acting like leadership. NVDA kept sliding even after strong earnings, and that really mattered for psychology. It's less about the quarter, more about the market stress testing the forward story, what happens after the infrastructure build-out, and that's why software felt heavy again. The tape wasn't panic, it was rotation, but it was a brutal rotation if you were crowded on the wrong side. One quick note on chatter, because it shaped how this all felt. There was a lot of desk talk about month-end de-risking and crowded positioning, like traders didn't need a new disaster to sell, just fewer reasons to stay brave. And you also had this growing narrative about AI splitting into winners and losers faster than people expected. To be clear, that's not a confirmed driver. It's the kind of framing that can spread on a red day and quietly amplify the move. Tonight, the AI war in Washington just went nuclear. President Trump ordered every federal agency to immediately stop using Anthropic's technology, full stop, a 6-month phase-down. And a warning: comply or face major civil and criminal consequences. This isn't about a contract dispute, it's about control. Anthropic refused Pentagon terms that could allow its models to be used for mass surveillance of Americans or fully autonomous weapons. CEO Dario Amodei said the company cannot in good conscience agree. The Defense Department pushed back hard, threatening to invoke the Defense Production Act, or even label Anthropic a supply chain threat. That label is usually reserved for adversarial foreign companies. Now here's where it gets interesting. OpenAI's CEO Sam Altman reportedly told staff they're in talks with the Pentagon too, offering classified model access, but with guardrails. So this isn't just policy friction, it's competitive positioning inside the national security AI stack. The Pentagon says it has no interest in surveilling Americans. Anthropic says the contract language would let safeguards be bypassed. Trump says federal agencies don't need Anthropic at all. So what does this mean? It signals a new phase of AI geopolitics, where model providers aren't just vendors, they're power brokers, and Washington just made it clear, in matters of national defense, the government decides the rules. This isn't just an AI headline. It's a precedent for how far the federal government is willing to go to control frontier models and how far AI companies are willing to resist. NVIDIA was the psychological center of the AI tape again. It kept sliding even after strong earnings, classic sell the news behavior in a market that just got picky about valuation. And with hotter inflation in the mix, high multiple leadership gets repriced fast, why it mattered today. NVIDIA is still the sentiment proxy for whether AI capex turns into durable profits. When the flagship doesn't get rewarded, confidence across the complex starts to wobble. Goldman Sachs was a loud tell that this wasn't just tech drama. Goldman sold off hard as the tape repriced inflation and the policy path. When capital markets names get hit like that, it reads like broad de-risking and tighter financial conditions vibes. Today's message: the risk intermediaries were getting sold, right alongside the AI generals. Apple was another big reason the index felt heavier than it looked. This didn't feel like a single stock story. It was macro positioning, duration getting unwound as inflation fears pressured growth multiples. When staples and healthcare are green, and Apple is a top drag, that's usually the market talking about regime, not product cycles. Netflix was the rare bright green outlier. Shares surged after Netflix walked away from a bidding war for Warner Bros. Discovery assets. Investors read it as capital discipline. In a risk-off tape, that's exactly the kind of behavior the market still rewards. Avoid deal risk, protect cash flow, don't overreach. Dell gave you the counterpoint to the AI sell-off. The stock popped on guidance and commentary that AI-optimized server revenue is expected to roughly double in fiscal 2027, plus richer shareholder returns, a dividend hike, and a bigger buyback authorization. So even on a day when AI valuation got punished, the market still showed appetite for AI picks and shovels with tangible revenue and real capital return. ExxonMobil was part of the session's rotation signature. Energy was bid alongside risk-off positioning, with higher crude and renewed U.S.-Iran tension in the day's news flow. On days like this, energy strength versus tech weakness is a classic tell, the market leaning toward real assets and cash flows, and away from long-duration growth. Now the forward look, because the next catalysts are already set. Next week brings ISM manufacturing and ISM prices on Monday, ADP and ISM services midweek. Then jobless claims and Friday's jobs report including wages. After today's hotter PPI and the rotation we just saw, traders will be watching, do rates calm down? And does AI leadership stabilize? Or does this prove-it pricing regime stick around a little longer? Bottom line, this was a rotation day. Defensives and energy offered shelter, but mega-cap tech and banks did the damage, and that mix tends to tighten the mood fast. The big question didn't get answered today, it just got louder. What happens as AI shifts from build-out to monetization, with inflation still leaving residue in the data? We'll see what the next prints do to rates, and whether the market wants to get brave again. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.